Stock market, a word and a world that fascinates many. But question is, what exactly is stock market and how does it work? How does one become multi-millionaire with this? Everything will be answered in this video. Welcome to Stock Market Series Part 1. Hi, I'm your host Riya, and in this series, I will guide you through the basic fundamental of the stock market, exploring its history, structure, functioning, key regulatory bodies, understanding Nifty 50, Sensex, as well as offering insights into investment strategy, market terminologies, and other essential concepts. But before we begin, make sure you have subscribed to our channel Freedom Money English so that you don't miss out on any of the update and download the Freedom app now. Well, Freedom app provides you multiple courses in 5 different languages and where you can access the comprehensive stock market course and can learn directly from our mentors at just Rs 399. So what are you waiting for? Download the app and buy the course right now. The stock market is a critical component of the financial system in India, providing companies with the means to raise capital and offering investors opportunity for growth. The stock market, also known as the equity market, is a platform where shares of publicly held companies are traded. It includes exchanges such as the Bombay Stock Exchange, also known as BSE, and the National Stock Exchange, also known as NSE. If we look at the historical background of India's stock market, it dates back to the 19th century. The BSE, the Bombay Stock Exchange, established in the year 1875, is the oldest stock exchange in Asia. The National Stock Exchange, NSE, founded in the year 1992, brought about significant changes with its electronic trading system, which increased the transparency and efficiency in trading. The Indian stock market primarily operates through 2 main exchanges, the BSE and the NSE. Both exchange facilitates the buying and the selling of securities including stocks, bonds and derivatives. The BSE has over 5,000 listed companies, while the NSE, known for its larger trading volumes, lists over 2,000 companies. Companies are listed on these exchanges and their performance can be tracked through the indices like Nifty and Sensex. Nifty 50 and Sensex includes the top companies of India based on the market capitalization. For example, Nifty 50 includes companies like Reliance Industries, HDFC, Infosys and many others. Let us understand this with an example. If you own shares in a company, you essentially own a part of that company. Let's say a company named X Limited wanted to open factories in Hyderabad, Bangalore and Visakhapatnam. They would need funds for this expansion. First, the company might seek a loan from a bank, but if they need additional funds, they might invite investors to invest in their company. If I, as an investor, buy shares in that company, I become a part owner and a share in that company's profit. If the company's share price increases from 150 to say 300, I gain a profit. The stock market can provide good returns on investments. For example, investing in a company at 200 rupees and selling it at 300 rupees yields you a profit of 100 rupees. The stock market sentiments in India specifically influences share prices. For example, a fake news or a rumor can affect share prices. That's why SEBI, which is Security and Exchange Board of India, regulates the market to prevent fraud and ensures fair trading. Companies that want to enter the stock market needs to follow a process known as the initial public offering, or in short IPO, where they issue shares to the public. For instance, between 15th to 17th, if a company issues a share, it becomes publicly traded on exchanges like NSE and BSE. As mentioned earlier, the performance of the Indian stock market is often gauged through 2 major indices, Sensex and Nifty. Sensex index represents 30 of the largest and most actively traded stocks on the BSE. It was created in 1986 and is considered as a barometer of the Indian economy. Whereas Nifty 50 index includes 50 diversified stocks on the NSE and provides a comprehensive overview of the market trends. Now a question arises, who regulates all these trades and buying and selling of stocks? Well, the Securities and Exchange Board of India, SEBI, is the regulatory authority overseeing the Indian stock market. Established in the year 1992, SEBI's mandate includes protecting investors' interest, promoting fair trading practices, and ensuring the development of the securities market. SEBI's regulations and guidelines are designed to maintain market integrity and prevent malpractices such as insider trading. Now let's understand the trading mechanism of Indian stock market. The Indian stock market operates on an electronic trading platform which ensures the transparency and the efficiency. Orders are matched using a computer system and the entire process is order driven, meaning the trades are executed based on the existing buy and sell orders. This system eliminates the need for market makers, making the trading process more straightforward for the investors. Trading on BSE and NSE occurs from 9:15 a.m. to 3:30 p.m. Indian Standard Time from Monday to Friday. The settlement process follows a T+1 cycle, meaning trades are settled the next business day. This ensures timely transfer of ownership and funds between the buyers and the sellers. Now let's talk about the type of markets. First, primary market. In the primary market, new securities are issued to the public through initial public offerings or called IPOs. This is where companies raises capital by selling shares for the very first time. Second, the secondary market. The secondary market is where existing securities are traded among the investors. The BSE and the NSEs are secondary markets where investors can buy and sell shares at prevailing market prices. Well, it is important to note that investing in the stock market requires a well thought out strategy to mitigate risk and maximize return. Some basic strategies includes: number 1, research and analysis. Investors should conduct thorough research on companies, including their financial health, market position, and growth prospects. Next, diversification. Spreading investment across different sectors and companies can reduce risk. Next, long-term investment. Holding investments for the long term can help investors ride out market volatility and benefit from compounding returns. And finally, stop-loss orders. Setting stop-loss orders can help limit potential losses by automatically selling a security when it reaches a predetermined price. Now let's understand key terminologies which are essential for navigating through the stock market. Number 1, demat account. An account that holds securities in electronic form, essential for trading in the stock market. Next, trading account. An account through which investors place buy and sell orders. Next, bull market, a market condition characterized by rising stock prices. Next, bear market, a market condition where stock prices are falling down. Another one, IPO, initial public offering, the process through which a private company offers shares to the public for the very first time. Next, bid and ask. The bid is the highest price a buyer is willing to pay for a stock, while the ask is the lowest price a seller is willing to accept. And finally, market capitalization, the total market value of a company's outstanding share. Now let's understand the role of brokers. Stockbrokers act as the intermediaries between investors and the stock exchange. They facilitate the buying and selling of securities and providing investment advice. Brokers charge a commission for their services, which varies based on the volume and the value of the trades. Investing in the stock market involves risk, including market volatility and the potential for losses. However, it also offers opportunities for significant returns. Investors should assess their risk tolerance and investment goals before entering the stock market. It is advisable to consult financial advisor and use reliable tools and resources to make informed decisions. To conclude, it would be right to say that the stock market in India is a dynamic and integral part of the country's economy. Understanding its basics from the structure and functioning to investing strategies and regulatory frameworks is crucial for any aspiring investor. By conducting thorough research, staying informed about the market trends, and adopting sound investment practices, investors can navigate the complexities of stock markets and achieve their financial goals. That's all in today's video. We'll see you soon with the part 2. Till then, make sure you have subscribed to our channel Freedom Money English and download the Freedom app, and do enroll for our stock market courses at just ₹399. Take care. Bye-bye.